Stocks. When you buy a stock, you're purchasing a piece of a company. You become a part owner, which means you get voting rights and might receive dividends depending on the type of stock. Those are cash payments companies distribute from their profits. There are two main types: common stock and preferred stock. Common stock gives you voting power, but dividends aren't guaranteed. Preferred stock flips that. You get priority on dividend payments, but usually no voting rights. The appeal of stocks is their long-term growth potential. Over a 25-year period, the S&P 500 has historically climbed around 370%. Stocks are liquid. You can sell them quickly when you need cash. But stocks are volatile. Prices swing dramatically based on company performance and market sentiment. During downturns, you can watch your investment drop sharply. In worst cases, if a company goes bankrupt, you could lose everything. Bonds. A bond is essentially an IOU. When you buy one, you're lending money to a government, municipality, or corporation. In exchange, they promise to pay you interest at regular intervals and return your principal when the bond matures. United States Treasuries are backed by the government. Municipal bonds come from state and local governments. Corporate bonds are issued by companies and carry varying risk levels based on credit ratings. The main draw is predictability. You know exactly how much interest you'll receive and when. They provide steady income and help diversify your portfolio because bonds typically move differently and returns are generally lower than stocks. When interest rates rise, existing bond prices fall. There's also inflation risk and the possibility of default with corporate bonds. Mutual funds and ETFs. Mutual funds and exchange-traded funds pool money from many investors to buy a diversified collection of stocks, bonds, or other assets. When you buy a share, you own a slice of that entire portfolio. The big advantage is instant diversification. A single fund might hold hundreds of different securities, spreading your risk. The main difference is how they trade. Mutual funds are bought and sold at the end of each trading day at the net asset value. Exchange-traded funds trade throughout the day like individual stocks. Both offer accessibility with low minimum investments. You can invest in almost any market or strategy. Index funds track major market indices. Sector funds focus on specific industries, but both charge annual management fees that eat into your returns. Exchange-traded funds typically have lower expense ratios and better tax efficiency. Real estate. Real estate investing means buying property to generate returns through rental income or price appreciation. This includes residential properties, commercial buildings, and raw land. Rental properties produce ongoing cash flow. Every month, tenants pay rent, and after covering expenses, what's left is your profit. Over time, property values often increase. Real estate also acts as an inflation hedge and provides portfolio diversification, but it requires substantial upfront capital. Real estate is illiquid. Selling takes weeks or months. There are ongoing costs like property taxes, insurance, maintenance, and repairs. During economic downturns, vacancy rates climb and property values can plummet. Commodities. Commodities are basic physical goods that fuel the global economy. This includes energy products like oil and natural gas, metals such as gold and silver, and agricultural products like wheat and corn. You can invest through physical assets like gold bars, but more commonly through futures contracts or commodity exchange-traded funds. Commodity prices move based on supply and demand, weather, and geopolitics. Commodities provide diversification and serve as an inflation hedge. When inflation heats up, commodity prices typically rise with it, but they come with serious volatility. Prices can swing wildly on global events. Unlike stocks or bonds, commodities produce no income. You're purely betting on price movements, Derivatives. Derivatives are financial contracts whose value depends on an underlying asset like stocks, bonds, commodities, or currencies. The most common are futures and options. A futures contract locks you into buying or selling something at a set price on a future date. An option gives you the right, but not the obligation to do so. Companies use derivatives to protect against price swings. Airlines buy oil futures to lock in fuel prices. Traders use them to bet on price movements. The power comes from leverage. You post a small margin deposit to control a large position. But if the market moves against you, losses are magnified. You can lose more than your initial investment. The 2008 financial crisis showed how devastating derivatives can be when used recklessly. Foreign exchange. The foreign exchange market is where currencies are bought and sold. It's the largest financial market on earth, with over $6 trillion changing hands daily. The market operates 24 hours a day across global time zones. Major currency pairs like Euro versus United States dollar versus Japanese yen, and British pound versus United States dollar dominate trading. Exchange rates fluctuate based on interest rates, inflation data, and political events. The advantage is extreme liquidity. You can enter and exit positions instantly. But foreign exchange is incredibly risky. When the United Kingdom voted for Brexit in 2016, the British pound crashed 13% in 1 week. Most foreign exchange trading is heavily leveraged. A leverage ratio of 50-1 is common, meaning a 2% move against you wipes out your entire investment. Cryptocurrencies. Cryptocurrencies are digital assets built on blockchain technology. The system operates without central authority like a bank or government. Bitcoin, created in 2009, was the first. Since then, thousands of others have emerged. Some act as digital money. Others power smart contracts. The decentralized nature makes them resistant to censorship. Cryptocurrencies enable fast, low-cost transfers, especially across borders. The potential for capital gains is enormous. Bitcoin's price has surged from pennies to tens of thousands of dollars, but the risks are severe. Prices can swing 20% in a single day. Cryptocurrencies generate no cash flow. Their value depends entirely on what someone else will pay. Regulation is evolving unpredictably, and unlike bank deposits, crypto has no government insurance. If you lose your password or face a hack, that money is gone forever. Cash and cash equivalents. Cash investments are the safest, most liquid assets. This includes physical currency, bank accounts, and cash equivalents like money market funds, certificates of deposit, and treasury bills that mature in 3 months or less. These assets carry minimal default risk. Bank savings accounts are Federal Deposit Insurance Corporation insured up to $250,000. Cash is instantly accessible. This makes cash crucial for emergency funds. Financial advisors recommend keeping 3 to 6 months of expenses in cash equivalents, but cash earns almost nothing. Interest rates rarely beat inflation. If inflation runs at 3% and your savings pays 1%, you're losing 2% of purchasing power annually. Cash is ineffective for long-term wealth building, but essential for short-term needs. Peer-to-peer lending and crowdfunding. These online platforms connect individual lenders directly with borrowers, cutting out banks. In peer-to-peer lending, investors fund personal or small business loans. Your money gets divided across multiple loans to spread risk. Equity crowdfunding lets you buy shares in startups. Instead of lending money, you're taking an ownership stake. The appeal is higher returns. Peer-to-peer loans often pay 5 to 10% or more, much better than savings accounts. But the risks are substantial. Default rates are significantly higher than conventional banks. There's no FDIC, Federal Deposit Insurance Corporation. Most startups fail. These investments lock up your money for years, with no easy way to sell.